Traditional education often places a strong emphasis on earning a degree and climbing the corporate ladder. Schools teach students to seek stable jobs and follow a predetermined career path. However, many wealthy individuals deviate from this conventional route. Instead of pursuing traditional degrees and office jobs, they focus on entrepreneurship and wealth-building strategies not covered in standard curricula. For instance, Elon Musk, who dropped out of Stanford, used his talents and vision to create groundbreaking companies rather than following a traditional educational path. This approach highlights a fundamental difference in how wealth is often built versus how society traditionally prepares individuals. The traditional model promotes the idea that higher education leads to higher income. While this can be true, it's not always the case. Wealthy individuals often acquire skills and knowledge outside the classroom, such as learning about investing, managing money, or starting businesses. Richard Branson, the founder of Virgin Group, famously struggled in school but succeeded by learning through real-world experiences and taking calculated risks. This shows that while education is valuable, it's not the sole path to financial success. Many high achievers focus on practical skills that aren't necessarily taught in schools. For example, understanding how to manage personal finances or identify profitable investment opportunities can be more beneficial than traditional academic knowledge. Books like Rich Dad, Poor Dad by Robert Kiyosaki can offer insights into financial literacy that aren't typically covered in formal education. Embracing these alternative learning methods can provide individuals with tools to build wealth effectively. Moreover, wealthy individuals often pursue continuous learning beyond formal education. They might engage in networking, mentorship, and self-education to stay ahead. Learning from successful mentors, attending workshops, or even consuming content related to wealth building can be more impactful than a conventional degree. This ongoing education helps them adapt to changing markets and seize new opportunities, a crucial aspect of maintaining and growing wealth. In many educational systems, financial literacy is often overlooked, leaving most people unprepared to manage their finances effectively. Schools typically don't cover essential topics like budgeting, investing, or managing debt. As a result, individuals might excel in their studies but struggle with their finances. For example, a person with a degree might find themselves overwhelmed by credit card debt simply because they were never taught how to manage it properly. This gap in education can lead to significant financial challenges despite having academic qualifications. A lack of financial education can lead to poor money management habits. People may not understand the importance of creating and sticking to a budget or the benefits of saving and investing. For instance, many might not realize the impact of compound interest on their savings or the difference between a good investment and a bad one. This ignorance can result in missed opportunities for wealth accumulation and financial stability. Reading books like The Millionaire Next Door by Thomas J. Stanley and William D. Danko can offer valuable insights into effective money management and wealth-building strategies. Financial ignorance is often exacerbated by the lack of practical advice available to the average person. Many financial products and services come with jargon that can be confusing. Individuals might struggle with understanding investment options, retirement plans, or insurance policies. Simplifying this information and seeking out resources that break down financial concepts into manageable pieces can make a significant difference. Engaging with financial advisors or using online tools to create a financial plan can also help bridge this knowledge gap. Moreover, financial ignorance can lead to poor decision-making, such as making high-interest loans or investing in risky schemes without proper research. For example, some may fall prey to get-rich-quick schemes or high-pressure sales tactics because they lack the knowledge to evaluate the risks and benefits properly. Educating oneself about personal finance and seeking advice from reputable sources can help avoid these pitfalls and make informed decisions that support long-term financial health. Inflation is a silent yet powerful force that erodes the purchasing power of money over time. Many people keep their savings in traditional bank accounts, assuming it's a safe and wise choice. However, inflation gradually diminishes the value of cash, making it less effective for preserving wealth. For example, if inflation is at 3% per year, $100 saved today will be worth only $97 in purchasing power next year. This slow erosion means that while your savings balance might look healthy, its real value is steadily declining. To combat inflation, investing becomes crucial. Simply stashing money under the mattress or in a low-interest savings account won't yield returns that outpace inflation. Instead, investing in assets such as stocks, bonds, or real estate can offer better protection against inflation. For instance, equities generally provide returns that exceed inflation over the long term, which helps in maintaining and growing your wealth. Consider diversifying your investments across various asset classes to build a robust portfolio that can weather inflationary pressures. Additionally, understanding the impact of inflation on different types of investments is essential. For instance, inflation-linked bonds, like Treasury inflation-protected securities, TIPS, can provide a hedge against rising prices by adjusting the principal and interest payments according to inflation rates. Real estate investments, known for their potential to appreciate and provide rental income, can also be an effective way to safeguard against inflation. By exploring these options, investors can better protect their financial future. It's also important to regularly review and adjust your investment strategy in response to changing inflation rates. As inflation fluctuates, the effectiveness of different investment strategies may vary. Staying informed about economic conditions and working with a financial advisor can help in making timely adjustments to your investment approach. For example, reallocating assets or increasing exposure to inflation-resistant investments can be strategies to consider. Understanding tax strategies is a crucial aspect of effective wealth management. Many people overlook the potential benefits of tax planning, leading to missed opportunities for optimizing their financial situation. By leveraging tax deductions and credits, individuals can significantly reduce their tax liability. For example, contributions to retirement accounts like a 401k or an IRA can be deducted from taxable income, lowering the amount owed to the IRS. This strategy not only reduces current tax bills, but also helps in building a secure financial future. Another important tax strategy involves strategic spending and investment. Certain expenditures, such as those related to business expenses or educational costs, can qualify for tax deductions. Additionally, investing in tax-advantaged accounts or assets, such as municipal bonds or health savings accounts, HSAs, can offer further tax benefits. For instance, municipal bond interest is often exempt from federal taxes, providing a way to earn income without increasing your tax burden. Tax planning should also include understanding the impact of capital gains and losses. By strategically selling investments, individuals can manage their capital gains and offset them with capital losses to minimize tax liability. For instance, if you have an investment that has appreciated significantly, selling it in a year when you have capital losses can help in reducing the overall tax impact. This practice, known as tax loss harvesting, is a valuable tool for optimizing investment returns. Consulting with a tax advisor can greatly enhance your ability to implement effective tax strategies. A knowledgeable tax professional can provide personalized advice based on your specific financial situation and goals. They can help identify potential tax-saving opportunities, recommend strategies for minimizing taxable income, and ensure compliance with current tax laws. Working with a tax advisor can provide peace of mind and help you make informed decisions. Real estate investment is a powerful tool for building wealth and securing financial stability. Unlike traditional savings accounts, which can be eroded by inflation, real estate offers tangible assets that can appreciate in value over time. For example, purchasing a rental property not only provides the potential for property value increase, but also generates a steady stream of rental income. This dual benefit makes real estate a compelling choice for those seeking to diversify their investment portfolios. One of the primary advantages of real estate is the potential for tax benefits. Real estate investors can take advantage of various tax deductions, such as mortgage interest, property taxes, and depreciation. Depreciation allows investors to deduct a portion of the property's value each year, which can significantly reduce taxable income. For instance, if you own a rental property, you can deduct the depreciation of the property structure, leading to potential savings on your overall tax bill. However, successful real estate investing requires a thorough understanding of market dynamics and careful management. It's essential to research and select properties in areas with strong growth potential and high demand. For example, investing in a neighborhood undergoing revitalization or expansion can offer significant returns. Additionally, effective property management is crucial to maintain the property's condition, attract quality tenants, and ensure a steady income stream. Real estate investments also require careful financial planning and risk management. It's important to consider factors such as financing options, property maintenance costs, and potential market fluctuations. Conducting a comprehensive financial analysis before making an investment can help you understand the potential return on investment, ROI, and make informed decisions. Using tools like cash flow analysis and ROI calculators can provide valuable insights into the financial viability of a property. In today's consumer-driven society, the allure of instant gratification often overshadows the long-term financial consequences of debt. Many people use credit cards and loans to finance consumer goods that provide short-term pleasure but result in long-term financial strain. For example, purchasing the latest smartphone on credit may seem enticing, but the interest accrued on the credit card balance can turn a simple purchase into a costly burden. Understanding the implications of using debt for consumer goods is crucial for maintaining financial health. Debt can be a double-edged sword. While it can be used strategically for investments that generate income, such as real estate or business ventures, it often becomes a tool for acquiring depreciable assets that don't contribute to wealth building. Instead of focusing on material possessions, which tend to lose value over time, individuals should consider using debt for investments that offer the potential for growth. For instance, financing education or starting a business can lead to increased earning potential and long-term financial benefits. Moreover, managing debt effectively involves understanding and controlling one's spending habits. Creating a budget that prioritizes savings and investments over discretionary spending can help avoid falling into a cycle of debt. Tools such as budgeting apps and financial planning software can assist in tracking expenses and setting financial goals. By setting aside a portion of income for savings and investments, individuals can build a financial cushion and reduce reliance on credit. Debt consolidation is another strategy that can help manage existing debt. By combining multiple debts into a single loan with a lower interest rate, individuals can simplify payments and reduce overall interest costs. For example, consolidating high-interest credit card debt into a lower-interest personal loan can lead to significant savings over time. However, it's important to address the underlying spending habits to prevent accumulating new debt.